Balance sheet is a way of organizing and summarizing what a firm owns, means its assets, and what a firm owes, means its debt or liabilities, and the difference between these two that we name it firm's equity at a given point in time. This means that a balance sheet has three main components: whatever a firm owns, whatever a company owns, and we name these as assets, and usually assets are reported on the left side of the balance sheet, and then on the right side we need to show how the firm could pay for these assets. For example, the assets can be machinery, building, maybe computer. So these are assets of the company and they will be reported on the left side. Then on the right side, we report how we paid for them, how we finance these assets. So there are two main sources of finance for a company. Number one is debt, means a company may borrow money, right? So for borrowing money, the company may get a loan, or maybe the company will issue bonds. For bonds, they will issue it and sell the bonds and they raise funds. So both loan and bonds, these are all different types of borrowing. So this is debt or liability. And then the second source of finance is equity, shareholders' equity, means the money that owners of the company or shareholders put in. So on the left side, we have all assets, and on the right side, we report how we finance, how we paid for these assets. So this is the reason it's balance sheet, because these two columns must be balanced, right? Now, for the assets, we group them into two main categories. Number one, fixed assets. Fixed asset means the assets that have a life longer than 1 year. In finance, actually, to say something is short-term or long-term, the criteria is to be less than the life, be less than shorter than 1 year or longer than 1 year. So 1 year is the threshold. So for fixed asset, we assume that the life of those assets is longer than 1 year. The example can be a truck. The life of a truck usually is more than 1 year, right? Or buildings, or maybe a computer. So these are fixed assets because their life is longer than 1 year. And then assets can be tangible or it can be intangible. For example, the truck, building, or computer, these are all tangible assets. You can see them, right? You can touch them. But we can have intangible assets as well, like trademark of a company. So as I said, there are two main groups of assets. Number one is fixed assets. Their life is longer than 1 year. And then we have short assets. I'm sorry, current assets, means their life is shorter than 1 year. So what type of asset? Can you give me an example? For example, inventory or cash, right? Why? Because what we mean by current assets, as I said, the life of the asset is less than 1 year. In other words, the asset can be normally converted into cash within 12 months. So any asset that can be converted into cash in less than 1 year, means in 12 months, we consider it as current assets. So why inventory is considered as a current asset? Because usually we expect to be converted into cash in less than 1 year, right? Another example can be cash itself. Cash can be converted into cash in less than 1 year because cash is already cash. So we consider it as a current asset. So another one, account receivable, means money that owed to the firm by its customers, money that you already sold something and you need to collect the money from the customers, and it's called account receivable. This is also a current asset because usually we expect to receive it in less than 1 year from the customers. Okay, so assets will be reported on the left side, and they can be fixed assets or current assets. And assets in general, they can be tangible or intangible. Now, on the right side, we have liabilities. and shareholders' equity. So liability means debt, right? And debt, again, can be into two main forms. One is current, the second one is long-term. So current debt or current liabilities. So again, we expect the life of these debts or the life of these liabilities to be less than 1 year. And then we call it current liability, current debt. For example, accounts payable means the money that the firm must pay to its suppliers, right? We expect to pay to our suppliers in less than 1 year. Another one, can you name any type of borrowing or loan that's the life is less than 1 year? It's considered as a current liability. Then we have long-term liabilities or long-term debts. So the example can be a long-term loan, for example, a loan that the company obtained for a 10-year period. So this is considered as a long-term liability, right? Long-term debt. So all types of liabilities or debt, they are reported on the right side. Actually, I can show it to you here. Yeah, as you can see, as it is shown here, on the left side, you can see the assets, the assets, and on the right side, you can see liability, and here shareholders' equity, right? So for assets, as you can see, we start with reporting current assets. In balance sheet, we always report the most liquid ones first. So the order is based on the liquidity. So the first one, as you can see, the first group will be current assets on the left side. And then we have fixed assets or non-current assets, right? And for current assets, as you can see, again, we start with cash because cash is the most liquid ones. And then we have account receivable and inventory. So it's based on the liquidity of the assets. And then we go to the long-term assets or non-current or fixed assets. And for fixed assets, again, based on their liquidity. And then on the right side, we just discussed the liability. Here, actually, there's space here. I need to remove it. So we start with liability. So we have current liability and then long-term liability, right? So again, we start with the most liquid ones and then the least liquid ones. And then we have shareholders' equity. So what is shareholders' equity? This means that if a firm sells, for example, all of its assets and use the money to pay off all debts, then whatever is left, and we call it residuals. So whatever residual value remain would belong to the shareholders. So the balance sheet balances because the value of the left hand side always equals the value of the right hand side. Actually, let me show you. Yeah. So we have this formula here, which is called balance sheet identity. So assets equals liability plus shareholders, means whatever you have on the left side equals whatever you have on the right side. So assets, when you sell all assets and you pay all types of liabilities, debt that you have, whatever that is left, you can pay to the shareholders. So okay, and okay, I just mentioned about liquidity. I just said that they are, we report assets or debt. We start from the most liquid ones, right? What do we mean by liquidity? Liquidity means how fast you can convert something into cash at a price very close to the market price. So there are two assumptions to consider something liquid. Number one, how fast you can convert something into cash. Assumption number two, at a price very close to the market price. So, for example, a car. Do you consider a car as a liquid asset? Not really, because if you want to convert it into cash, it takes time. When you want to sell your car, you cannot immediately convert it into cash. If you want to do, then you have to sell it much cheaper than the market price. So it's not liquid. But what about gold? Gold is very liquid because immediately you can convert it into cash at a price very close to the market price. So this is the meaning of liquidity. And here, as you can see, we have a term net working capital. Net working capital is the difference between current assets and current liabilities. So current assets minus current liabilities is called net working capital. So net working capital, we expect to be positive for healthy firms because it means that the cash that will become available over the next year or next 12 months should exceed the cash that must be paid over the same period of 1 year. For this reason, in a healthy firm, net working capital is usually positive. So we expect the firm should be able to pay its current liability using its current assets. And if current assets is more than current liabilities, this means the firm is healthy. So it's a good sign.